From clothes to toys to electronics, the Made in China label has flooded the U.S. market. Could the auto industry be next? The Biden administration has announced a 100% tariff on electric vehicles imported from Beijing this week, trying to protect American manufacturers. Former President Trump says he'd raise tariffs even higher. But the threat might be overblown if U.S. automakers step up their game. It's the Barron's cover story this week, and associate editor Al Root joins the panel. Al, great story. I learned a lot of stuff. Let's start with, I really did, the Alliance for American Manufacturers says Chinese EVs, quote, could end up being an extinction-level event for U.S. automakers. What's driving all this concern?
Yeah, I don't know why I should be surprised you liked it, but that always surprises me. Listen, a $10,000 car, it just isn't the threat that you think it is. Now, BYD is a real competitor. There's lots of things that are reasons people are afraid. China's the largest market for new cars now. It's the largest maker of electric vehicles. BYD made 3 million electrified cars last year. In the fourth quarter, they actually sold more cars, all electric cars, than Tesla. So there's lots of reasons that you should be afraid. But we can get to the $10,000 car in a second. There's no Chinese branded car sold in America right now. There's no Chinese capacity on this continent except a small joint venture plant in Mexico. The Chinese will export cars. They're going to start in Europe, and they also ship cars to Southeast Asia and places like that. The threat for the U.S. is literally a decade away, and that makes these tariffs to some extent politically motivated, and you can even see that in this sort of back and forth of I can raise tariffs higher than you.
All right. So we saw the yellow car. That's called the Seagull. You said it looks like a minion from behind. I'm not rushing to the dealership for one of those, but I could see a recent grad, a $10,000 electric vehicle. Hey, that sounds like a good deal.
Yeah, and it's not that nobody likes a good deal, and it's not that. But the thing about the Seagull, it's just not magic. General Motors can make cheap cars too. They have a $5,000 EV in China. The market sort of decides the kind of cars that you purchase. And, you know, those college students, you know, the cheapest 10 cars in the U.S., they garnered about 6% of the market in 2023. That's the market for the cheapest cars. And then the kind of market that you're in, whether it's China or India, Mexico or here, that sort of sets the price of the cheapest cars. You know, like you're not going to run out and buy the Seagull because Americans tend not to want stripped down cheap cars. You know, it is always a nice headline. We use the Yugo analogy in the story. You know, it was a $4,000 car and it seems great, but then service is a problem, reliability is a problem. It's actually very expensive to get it fixed. Remember, the upfront cost is only one portion of the equation there.
So what do you think U.S. automakers need to do to head off this Chinese competition?
So the way I liked it best, we were chatting with the president of Volkswagen America, Pablo Deci, and he was sort of pragmatic, and he's a foreign automaker with capacity in the U.S. He said, listen, these tariffs can't last forever. It gives you sort of 10 years to get your act together. So what do you have to do? You have to, you know, when Ford and General Motors faced the threat from the Japanese over the last 40 years, they were sort of content to just sell SUVs and trucks and cede all the rest of the market for smaller cars to imports. Not exactly the best strategy. You have to build a full lineup of attractive cars, and you have to defend market share. You have to compete. You have to sort of strategically say, all right, what am I going to do? You know, for Ford, I think they should be very careful to protect smaller truck share. General Motors is introducing cheaper EVs this year. They should continue to do things like that. They should not do what they did. And the thing about electric vehicles, batteries are about 2 times the price of labor in a car, right? So labor costs in China have been an issue. The battery, having low-cost batteries can become a defining competitive advantage. So it gives you a chance to make a better car without just throwing up your hands and saying, I can't compete with Chinese labor.
I thought you were going to say a lot of cup holders and wide seats for big American backsides. But which U.S. auto company would you say is the most at risk right now?
Clearly, it's Tesla. And, you know, if you go back to that, the Japanese, Tesla is the General Motors of electric vehicles. It has about 50% market share in the U.S. When General Motors first saw those Toyota cars coming into their market, they had about 50% market share. So Tesla has the most to lose. It's clear as day. And they need to do the same thing, right? They basically have two popular models, the 3 and the Y. And they basically said, we're selling so many cars, I don't need a small car. And then BYD comes along, growth collapses for Tesla, and now they're trying to accelerate their small car. They need a full product lineup that people want.
And we should say briefly that while China could slap tariffs on Tesla, they're a little bit less vulnerable because they actually build things in China.
Yeah, it's more about general business climate for American businesses in China. And, Americans and Chinese aren't getting along so well. So that's the risk.
That is true. Thanks, Al.